Hello, everybody. Mike Molina here. Well, I have a game changer of a product to share with you. And I promise you, I know this is a little bit of a longer video, but if you'll stick with me through to the end, I promise it'll be well worth your time. First, I'd like to take just a second to remind everybody that if you can, please donate whatever you can spare to the Humane Society of the United States. They're doing great work in saving the pets that were affected by the hurricanes in the East Coast. Anything you can spare will be greatly appreciated. First, we have to talk about rates because no doubt you heard that on Monday, rates spiked. Most of this has to do with panic over the unrest in the Middle East with the war between Israel and Iran. Escalations were really mounting, as you probably know. And Friday, we started to see rates really deteriorate in anticipation of the retaliatory strike. Fortunately, Israel didn't go as far as some feared. And as a result, oil prices came back down. The stock market did a little bit better. But rates are still suffering because there's still a lot of apprehension about the future. As long as that continues, we might be struggling with rates. However, we do have a big week in economic reports coming out that could offset some of that. So let's take a look at that. Okay, so now that I've depressed you with all the possible bad news, let me give you some good news. So the problem is, the topic of discussion today is we have a house that we need to sell, but we want to buy before we sell. And how do we resolve that? Well, let's talk about that. There are more or less about 6 options. So I want to talk briefly about the pros and cons of them. Of course, there's a concurrent closing. We all know how that works. Same thing with contingent offers. We all know how that works. Next, bridge loans. Bridge loans are great in the right circumstance. They do serve a certain niche, but they have some drawbacks. First of all, they're very expensive. Next, they do require significant equity. There must be enough to borrow, and there must be some left over. Borrowers also have to qualify for all the mortgage payments for the loans against their departing residents, plus the proposed mortgage payments for the purchase loan of the new residents. Or if they want to omit the mortgage payments on the departing residents, they have to use the bridge loan provider's loan product to purchase the new home, and it has high fees and has a high rate. So that is a significant drawback. Next, home equity lines of credit, or HELOCs. These are very similar to bridge loans. However, the fees are far, far less, very minuscule, usually only a few hundred to $1,000. They do require significant equity. They do have to qualify for all the mortgage payments on both the departing residents and the proposed mortgage payments to qualify for the loan for the new residence that they're buying. The benefits are that there's no restrictions on what type of loan product they can use for the new purchase. And as I said before, the fees are far less. So if the borrower is a very strong borrower, can qualify for all these mortgage payments, HELOCs are a great way to go. The last 2 options are somewhat new to the marketplace, and I want to talk about both. That is the option of using iBuyers. So there's iBuyers that are used to purchase the new home. So an example of this is a company called Homeward. They're based out of Austin, Texas, and they assess the old home, the departing residents, to determine the value, and they make a minimum guaranteed offer, or MGO. It is usually 20 to 30% below market. They must have at least 20% equity in the current residence for them to even consider making an offer. Then what Homeward does is they make a cash offer on the new home. Homeward is the buyer. Then Homeward rents back to the client the new home until they sell their old home. Upon sale of the old home, Homeward sells the new home back to the client. The client pays a convenience fee. Now, this program is restrictive on what property types Homeward will buy. And they also are very restrictive on selling it. So as soon as they close on the purchase of the new home, they must list the old home within 21 days and sell usually within 90 to 121 days, or Homeward executes on their minimum guaranteed offer. So as you can see, this loan does have some benefits. The biggest one being that they can make a cash offer on a new home and possibly get a new deal, but there is the potential for some serious problems and potential losses for the client. The next iBuyer program is the iBuyer for the old home. So a lot of agents in Utah have heard of this. It's called HomeLight. They're based out of Scottsdale, Arizona. And what this does is this program leverages Fannie and Freddie Mae guidelines to omit the payment on the departing residents in order to qualify for the new home purchase loan. So I'm leaving a link in the video, the email, and also on YouTube in the notes where you can go and you can watch a whole video on it if you really want to. It's about a 45-minute video. So some key things to note. It must be a primary residence to primary residence transaction. So they can't be selling an investment property and buying a second home, or selling a second home and buying a primary residence. They must be departing from their primary residence and buying a primary residence. This loan is very equity dependent. Just like Homeward, HomeLight executes a 90-day minimum guaranteed offer contract on the departing residents between themselves and the client as a backup offer. The fee is 2.4% of the final sales price of the departing residence, whatever that happens to be, plus agent commissions. Okay. Now, you can use the MGO by itself, which will allow the client to omit the payment of the mortgage on the departing residence when qualifying for the loan to purchase the new home. Okay. Or they also will pre-qualify the client for something that they call the equity unlock loan. And this is a loan that they place also on the departing residence as a second lien up to 70% combined loan to value. So the first mortgage that already exists plus the one they're doing can't exceed 70%. They say 70%, but typically it actually ends up being between 55 and 65%. Okay. Then the client can then take the money from the equity unlock loan and go shopping and with a non-contingent offer, at least as a home sale contingency goes, for a new home. And there's no payments on the old home counted against them for any mortgages when qualifying for the loan to buy the new home. And they can use whatever lender or agent they want in these transactions. The HomeLight equity unlock loan is zero interest, zero payment. And the client can use the money for the down payment on the new home, paying off debt, etc., and so on. Now, here's the thing with the HomeLight contingent offer and their program. Like Homeward, they have to list the home within 21 days upon closing of the new home that they're buying. Then they have 90 days to go under contract and 120 days to close on that contract. If they are not under contract within 90 days, HomeLight executes the MGO. They then say that they relist the home at full market value and less any fees that they incur, give the client any proceeds from the sale. Now, this begs the question, well, how come they can sell it at full market value and the client couldn't? So, you can see that there's a potential for all sorts of problems with this. So I have my questions about how good this is for the client, but I'll let you make your own determination on that. So what if there was a loan product out there that allowed a client to omit the mortgage payment on the departing resident so that they could qualify for the new purchase money loan easily, had fewer requirements, no additional costs, no additional time, literally easy, free, and fast? Well, that loan does exist, and it's Intercap's Buy Before You Sell Platinum program. So let's talk about the departing resident. So the requirements are, it must be a primary to primary residence transaction only. Just like as we mentioned previously, because it utilizes Fannie and Freddie guidelines to omit the mortgage payment on the departing residence so that you can more easily qualify for the purchase money loan to buy the new residence. The maximum combined loan to value of all the liens against the departing residence cannot exceed 80%. So there must be at least 20% equity in the home. There are 12 months of reserves required for the departing residence, equal to 12 months of payments for all PITIH, that's principal, interest, taxes, insurance, HOA payments for all liens against the departing resident. So if the first mortgage, if there's a second mortgage, the HOA fee all add up to $1,000 a month, we need $12,000 in reserves on the departing residents. Those are the requirements. What are the benefits? Well, most importantly, it allows the omission of all payments on the departing residents to qualify for the purchase loan on the new home. There are no additional fees. There are no additional pre-approvals required, and there are no property type restrictions. So what are the requirements for the purchase money loan for the new home? Well, again, it has to be a primary to primary residence transaction. It's only available for conventional and jumbo loans. You can't do this with FHA, VA, or USDA, no government loans. It allows for omission of the payments on the departing residents in qualifying for the purchase loan on the new home. Now, here's the key thing. this is really the one big requirement. The client must sign a letter of intent to list the home, the departing residence, within 90 days of closing on the new home for purchase. That is literally it. There's no follow-up on this. There's no time frame on when they have to have it sold by. They simply have to provide a letter. It's not even notarized. It's just their signature on a piece of paper swearing that they are being honest, that they are going to list their departing residence within 90 days of closing on the new home. And that is the defining factor in this program. Some other things to note: the minimum down payment is 10% with a 740 or higher FICO score. If their FICO scores are less than 740, then the down payment goes up in 5% increments. To give you an example, on the higher end, if their FICO score is 680, then they would need a 20% down payment. So it's not bad, but there is a sliding scale. Now, here's the thing. All of these other programs that I've shown you, all require a lot of equity, and some of them employ use of that equity for a down payment in some form or fashion, even if it's just outright buying the old home so that the iBuyer buys for cash the new home. So all of them require equity. And if that's the case, if our client has a lot of equity, then we can put a home equity line of credit on the departing residents. We don't even have to count the payment against them, and they can use that money for a down payment, reserves, paying off debt, etc., and so forth on the new home. So it really is just that easy. There's nothing else that I'm not telling you. This is every single requirement that there is for this loan. So right now, you might be thinking, well, what happens when they sell their home? They're going to get a big chunk of money probably, and they're going to want to put it down on their new home, but they're not going to be able to lower their payment unless they refinance. And maybe refinancing right at that time is not a good idea. I mean, for one thing, most likely they will have just paid a bunch of closing costs to get the mortgage that they've got, and then they're going to refinance again. And what if rates haven't come down enough to make it worthwhile? Then they're going to refinance, and then maybe several months or less than a year later, refinance again. That's a lot of fees to pay for refinancing. So that doesn't seem very fair or practical. So there has to be another solution. Unfortunately, there is. It's called recasting, and is even simpler than the loan I just explained. So it's not even a loan. Recasting is available on most conventional and jumbo products. And how it works is simply this. The client calls up their servicing lender, say, hey, I have a big chunk of money and I want to pay down my principal balance and recast my loan. The servicing lender says, okay, no problem. The client makes the large principal reduction payment. Then whatever the new balance, the remaining balance on their mortgage loan is re-amortized over the remaining term of their loan. So if they had a $500,000 loan and they make a $100,000 principal reduction payment, and they've had the loan for 5 months out of their 360 months, which is 30 years, okay? Then 500,000 minus 100,000 is 400,000. We take that 400,000 and we re-amortize it over the remaining 355 months of their loan. So that dramatically reduces their principal and interest payment. So their overall mortgage payment goes down dramatically. And the total cost to do that is somewhere between $150 and $400. There's no qualifying. There's no credit checks. There's no job verification. There's no asset verification. There's no reserves verification. It's simply, hey, I want to do this. You do it, you pay a fee, and it's done. Guaranteed every time, 100%. Now, here is a comparison between recasting versus mortgage refinancing. It analyzes 5 factors, the most important ones: what happens to the loan balance, the monthly payment, the interest rate, the loan term, and what the costs are. So recasting is here, refinancing is here. So in recasting, the loan balance goes down. In mortgage refinancing, depending on the type of refinance the client wants to do, the balance could stay the same, it could go up, or it could go down. In recasting, the monthly payment always goes down because that is the point. In refinancing, the payment could stay the same. It could go up or could go down depending on what type of refinancing the client wants to do. The interest rate in recasting always stays the same. In refinancing, it could stay the same. It could go up or it could go down depending on the type of refinance that the client wants to do. And the loan term, so how long the loan lasts, it stays the same. It doesn't change at all. You don't gain any months, you don't lose any months. But with refinancing, you could reset it to 30 years, change it to 10 years, 15 years, whatever you want to do. And the cost, it's a set $150 to $400, whereas refinancing is typically going to be around 2% of the loan. So it has to fit the right situation. Recasting is really great in a rate increasing market. Supposedly, we're in a rate decreasing market. Doesn't feel like it right at the moment, but we'll get there. But as I said before, there's many reasons why a client would want to choose to recast instead of refinance when they sell their home, because this is probably going to be a short time frame, right? They buy the new home, they list the old home, they sell it within probably 90 days, and they just had all those closing costs, and rates are probably not going to be low enough to make it worth it. So why pay all the fees to refinance when they're probably going to just be refinancing again in less than a year? So recasting in this case, even though rates are supposedly declining, makes a lot of sense. But it's just, I want to point it out because it's a very powerful, available option. So that is it. I hope you are as excited about hearing this as I was to share it with you. I've been preparing this video for many, many days because I wanted to cram it all in as much as I could. I covered just about everything. I'm going to have the slides available for you to download, so please do so. And of course, I'm always happy to talk to you and take a deeper dive and explain anything you need me to, or clarify any confusion or answer any questions. Thank you so much. If you could, please share this with a colleague, real estate colleague, or CPA, attorney, financial planner. Share it with a friend, like the video, and if you can, subscribe to the channel. It would help so much. Thank you so much and have a wonderful day. We'll talk with you soon. Take care.